This is my financial disclaimer so I don't get sued.
Good morning, good evening, good whatever time it is you're listening to this. I hope you're having a good one. Let's take a look at what we're covering in today's video. In this video, we'll be specifically just going over TLT slash treasuries and any information or symbols I believe help support or, go against our thesis. So with that said, let's go ahead and jump straight into TLT. So I'll explain this chart before I go over it. The blue is the 20-year yield. So even though Webull doesn't have the 20-year US yield, you can use the US 10-year and the US 30-year, excuse me, to correlate this data set. And you can also use TLT to correlate this as well. The red is the federal funds rate slash the interest rate. And this is the effective rate. This isn't the quote unquote exact rate. This is the effective rate of what the overnight is trading at. Okay. So if the Fed has the rates between, say, 3.5% to 3.75%, then the effective rate would be between that somewhere. Okay. And the purple is the unemployment rate. That speaks for itself. If you see it moving upward, that's a bad thing. That means people are losing their jobs. So let's kind of go over all of this in tandem. Okay. When we see the federal funds rate, that's the red, start to pull up, generally we see the unemployment rate start to pull up after the Fed starts raising their rates. Okay, in each cycle, and I could go back further. I'll do that just for the sake of showing, but things do change slightly. Um, when the rates go up, that's when the unemployment rate goes up. Now, it looks a little deceiving because the Fed starts to cut, and sometimes you see the unemployment rate continue trending above that, but that happens many times. So, for example, right here, the Fed starts to cut, but we see the unemployment rate continuing to trend upward for quite a while, for multiple years after the Fed really starts to cut, basically to 0%. Um, this isn't exactly ZERP right here, and when I mean ZERP, that's zero interest rate policy. Basically, this is ZERP. It's almost at the bottom, but then we see the federal funds rate pull up again. And what do we see? We see the interest rates start pulling down, and then all of a sudden, or not the interest rates, but the unemployment rate. The unemployment rate starts pulling down. Right in that, basically that curve of where the unemployment starts picking back up, that's when the Fed really says, okay, the interest rates are neutral. Let's see what happens. Well, what happens? Massive increase in the unemployment. And of course, that was the whole 2028 debacle. Same thing, though, was happening in 2018. We were seeing the interest rates being raised heavily, heavily, heavily. And then all of a sudden, there wasn't an increase in unemployment here. However, there were starting to be major um, issues in the Treasury market. A lot of prior to COVID was pretty much within the Treasuries already. Even though I don't think people anticipated it to be this big of a reaction, they were already starting to see that something was going on in the curve. Um, if COVID didn't happen and you could kind of erase from here to here and put this curve to where we're at, currently, um, that would be one of these previous curves to the upside. So this was caused by COVID, but truly, this whole area right in here was just because of COVID. Um, if that wasn't because of, if COVID didn't occur then, we would have probably seen the Fed continuing to raise interest rates slightly, probably would have seen the yields moving slightly higher. and then seeing, unemployment increasing and then seeing the major cut. Now, with COVID, that kind of messes up the cycle a little bit, but we still follow these previous cycles. And after the Fed finds their neutral grounding, they never really pause and then start increasing rates again. It's always find that neutral ground where it really just breaks everything and then go to zero. Find a neutral ground where it breaks everything, go to zero. Even back here, when the yields pull down to, or when the effective rate pulled down to 3%, which I guess at that time it probably would have been 2.75 to 3% rate, or 3 to 3.25% rate at the time. Um, this could be essentially be considered a ZERP as well, because the whole ZERP process didn't really start until really the early 2000s. So there's still a little bit of history that's needing to occur in that. But many people are expecting the yields to continue pushing upward and the unemployment to drop off after heavily increasing. Now, the only time we saw that happen was after the 2008 recession, or the early 2000 and one recession. And when that happened, the Fed was sitting at almost a 0% rate. They were sitting at looks like a 1 point, probably sitting between a 1 to 1.25% rate at the time. They exited a recession, and so they were taking all the necessary steps to break that unemployment. Um, all they could have further have done is continue dropping the rate further. However, they were starting to see the unemployment rate curve down. So they didn't need to drop it to the 0%. There was no necessity at that time. Um, so yeah, that's just kind of what's running through my head a little bit. Seeing some of the correlations here. Sorry, my mouse keeps spazzing between the three of them. Is that every time we see the interest rates, or the federal funds rate pull upward, we generally see a slight decline in the unemployment rate. Then we see the interest rate be held neutral, and during that neutral cycle, or during the cutting cycle, is when you start to see the unemployment rate really start to increase. Now, obviously, we've been seeing a slight trend, and I say slight, but it's really been occurring since basically 2000, early 2022, that the unemployment rate has been moving up and up and up and up and up. And some of the state data has their unemployment rate. It's went from 1% all the way up to 5 to 6%. So, um, definitely a major number to look at. The thing is, though, with the Treasury yield, and this is kind of the major correlation I want to make here, is that when the Fed starts cutting rates drastically, you always see a little bit of stickiness within the long end. As you could see, it starts pulling down, it holds steady even when the recession is mentioned. It's holding steady in here, and then it starts pulling down, pulls back up, then it's pulling down slowly, slowly pulling down towards where the Fed was, trading at that 0% interest rate. Um, we're seeing the exact same thing occurring right here. I don't believe we're in the process of seeing the interest rates continuing to move upward while we're seeing unemployment moving upward and the federal funds rate moving downward. That's just not how the economics behind it work. Um, there's years and years and years and years and years of history. So this isn't just some random correlation. This is, you know, exactly how it works. So, is this just some minor stickiness, or are we going to continue to see the yields holding at this rate and pulling upward? I think it's minor stickiness. Now, going to the 10-year chart.
If you're enjoying this, please check out my Patreon. For just $1 a month, you can join our community chat and access our tools like the Unusual Whale Spot and our own personal GEX and DEX market positioning. My $12.99 premium tier gives access to my personal trades, 2 live classes a week, which are on Wednesdays and Sundays, and direct support from myself. The links to join are below, but you can also join through patreon.com/wooksy. Thank you for supporting me to help you build skills for a lifetime.
And even within the 10-year chart, we see this occurring. And this is the 5-year time frame. But since the high of the 4.93% in the 10-year, we have just been seeing a major downtrend. Now, there has been a little bit of stickiness here, but we've seen a little bit of stickiness in the past. I believe this is back when the prior, yeah, this is back at the end of July when we were seeing the yen carry trade really starting to blow up, which we're not past that, and I'm going to show that in just a couple minutes here. But we saw the yields pull down drastically and then they went back up again. Um, the reason why they really went back up again was primarily because of President Trump being priced in to the market. Now, even with all of the tariff disruptions and everything going on that could potentially skyrocket the rates, we have not been seeing the rates increase. Even just going over a yearly trend, this is still holding a yearly trend. And I wish I could draw it out. Weeble just does not allow me to do that. But even just within a yearly trend, we're still holding the selling channel within that yearly trend. In the major trend of the treasuries, you would take this support range right here, this support range right here, resistance range at the top, and then you'd see the exact major selling channel that I'm talking about. Not even the one just since President Trump's been in office, but the one starting since all the way in the end of 2023. Um, with that said, let's go ahead and look at the USD JPY. Now, this is when the Bank of Japan had to increase their interest rates. Now, they did have a little bit of a pull down from that. During this time, they were selling off quite a bit of treasuries, and that's why we saw a little bit of stickiness within TLT. I wish I could overline or line up these two charts together. I know you can, but I don't know how to do it on the computer right now. But this is almost exactly opposite of TLT in terms of the stickiness that's been occurring, and this is running almost exactly with the 10-year right now in terms of it holding that stickiness. You can see that pattern occurring. Um, Now, with this stickiness, the thing is that we should be seeing the USD JPY pulling downward after the Bank of Japan cut rates, or I mean increase their rates by 25 basis points. That's how it's supposed to work because this is inverse of the yen. When we see this moving upward, the yen is losing strength. When we see this dropping, the yen is gaining strength. Now, we currently have the USD, the DXY, the dollar, pulling downward overall, and that moves downward with the interest rates. That's something that is a guaranteed. Um, that's how the dollar trades is it moves in tandem with the interest rates. If the interest rates are pulling up higher, then the dollar will be pulling up, unless there's some absurd collateral or deal going on. But in general, that is how the dollar will be trading. Now, with that said, with the dollar pulling downward, with the interest rate pulling downward, we should be seeing the yen gaining strength. We should be seeing the USD yen dropping. With it not dropping, that means it's still heavily, heavily, heavily inflicting pain on the Japanese market. This means that Japan is having immense struggles trying to sell treasuries, and I know they've been saying their auctions have been doing very well. I looked at their auctions and they haven't been. They've been having to increase the yields very, very drastically to um entice buyers. So that's not true at all. Um the yen carry trade has not unwound, but it hasn't been put in a position to not unwind either. It's still in very, very dangerous waters. And with the DXY still elevated, let me go ahead and pull that up. Even though it is pulling downward, we've been talking about this potential bullish structure on the dollar. It is starting to look a little dicey in terms of pulling back upwards because, again, once it pulls down to that 96.22, that really cancels out the previous bullish structure. However, this is still in a bullish stance. We could still be seeing strength pulling up into the dollar. And with the yen pulling downward, that's not a good thing. That means that the carry trade can still be in a stance to unwind drastically. And we know that Japan has sold um, you know, trillions of yen worth of US treasuries just within the last month and a half. So they're not out of the woods on this yet. What else did I want to cover on this? I wanted to cover FXY because I have a position in that right now, as well as TLT. I can find it because I'm blind. Hold on. FXY. Now, FXY does not trade a lot of volume, okay? It is a slow mover. It does have decent liquidity within the options though. And what we should be expecting is that when this pulls down, this means that the yen is losing strength. This is when the last yen carry trade unwound. We saw the FXY pull down. It was probably 58, but with dividends and everything, now it's at 57. So we're just going to go off of the pre-dividend value or, the post-dividend value. But the 57.17 is what it pulled down to, and it went all the way back up to 65.88. Now, currently, I have calls for 59. There are 59 strike calls for March. I forgot the date, but it was whatever was available in March. Um, if we get the unwind occurring, then we're going to see some very, very, very massive upside for those contracts. Potentially, a whole 10 points. That'd be a massive trade as I think my contracts only cost me $15 per. They were only 0.15 per. Very, very cheap. Um, definitely like the position a lot. I'll be adding a lot more to them, very likely. But this is a hedge to the Japan carry unwind. Now, going back to TLT, is that in our TLT chart, we have been seeing that same stickiness. We had that head and shoulders play out to the downside, and now we're seeing some support building. Going over the drawings, and it's going to be a mess. I apologize again, but I want you to look at this yellow cup and handle. Is that this cup is forming support right at the bottom of a major buying channel, which has strength for years and years and years and years. Okay. I believe this is a buying channel since 2018, something like that. Now, with us building support at the bottom of that buying channel and building support at the bottom of that major consolidation channel, the very high likelihood is that we should be seeing that upside. And that upside should take us all the way back up to the 91.17. It was truly 92, but we have had a few dividends since then, and that does take away from the price. So, you know, we're looking towards that 91. 20-ish range towards that upside. Now, from that range, we should anticipate some form of, you know, rejection at that, some form of rejection to occur there so that we can have this major cups nested cup and handle. And I say nested because we are looking for another cup to form here. And from that cup, either we can have the breakout occur at that top of the cup, or we can see it build an additional handle and then form the breakout. But I am expecting this support range to hold very well, and from the support range to see the buying to the upside. Now that the Bank of Japan has really sold their treasuries, they don't have a whole lot left to sell. They have equities, and they have some other instruments. They still have some treasuries they can sell, but I don't really think they're going to want to liquidate the long end too much further than they already did. But the last carry trade, just to really put this all in perspective, we saw the market price go from, it's back in here, we saw it go from 84, and I want to say it was actually 86 at the time because I traded it, because I had 88 calls. And it went all the way up to 99. It says 95, almost 96. But again, that's the dividends taking away from the price, but it went all the way up to the 99 point, and that was just over a period of, a few months. Um, a very, very strong move. And if we see continued bullishness within this structure, that will complete this bullish structure, and it further aligns us to this larger bullish structure, which is at the 95, 96. That was again at the 97, but we have had a few dividends since then. So, we're aiming for that top of the cup, that to adjust it. So that's truly what the thesis is right now. Um, with QT ending, with not really QE, but QE started with the RMP program. That has always transitioned into starting QE. And the reason why is because the RMP program needs short end treasuries as collateral, and the Fed is actively buying those short end out. Okay, so to get the collateral, to get this money, you have to sell some short end treasuries while locking up some short end treasuries as the collateral. Um, they're trying to burn out the short end of the curve, and what this will cause is the short end to really drop down massively, and that's what we're kind of waiting for right now at this point, is that we're at the point of the curve where the 10-year is going to trend above the lower end of the curve, s- and we're really anticipating the lower end to drop drastically. Um, from that drop, that's going to increase the spread between the 2-year and the 10-year spread. And that's really when you start getting the fun starting to occur. And really, that's when we get the big price action to the upside in TLT. Um, I know many people have been beating on TLT for a while and saying that everyone in here is a bag holder and everything. I heavily disagree. I think that there's potentially trillions of dollars waiting to be allocated into the treasury market. And we have been seeing stickiness, and we have been seeing a lot of, just a lot of things have been going on in the last few months. Since September, we've had the government shutdown, which was the longest government shutdown in history. We've had the Fed having multiple dissenting rate cuts, which, again, that's not the first time in history, but it's definitely something different. We have the tariff pressures from the whole year that have been weighing against us. We have the Bank of Japan potentially, last few months they've sold off tons and tons and tons of treasuries. and we're still holding support. We're still holding strength. We're still holding our bullish structures. Um, so am I really worried about the treasury market in the long end right now? No, I'm not. If we start really breaking down below that 80 range and really start invalidating the bullish structure, then that's when I worry. But until then, everything's telling me that we will be seeing the yields falling off. We will be seeing the long end starting to slowly drop down, and we will be seeing a lot of weight pull into TLT. So that's kind of the video. Hopefully it wasn't too long, but I do see a very, very bullish stance on TLT. I do see the direction, but I do see where the bears are coming from. There is a lot of headwinds for treasuries with the United States debt continuing to grow day after day after day. But the thing about the debt is that the Fed knows that the government is not spending correctly. And because they're not spending correctly, they know the way to counter that is to enter the ZERP process. And once you enter that ZERP process, that's when you could start refunding a lot of this debt basically at 0%. That allows the Fed to really just replace a lot of this old debt at 0% and kick the can until congressional means change the spending and change the monetary outlook that the Fed can really look into and say that we don't have to enter a ZERP process to keep things going anymore because the government's spending um you know with their heads screwed on correctly. With that said, I am bullish in TLT overall. A lot of our positions have gotten cooked over the last month. I apologize for that, but I can't really change what happened. We had the government shutdown and everything else occur. And if anything, I see a lot more signals now that we should be buying into this. Uh, I have positions for the 96 strike for March, and what that really is expecting this gap to close all the way back up towards the top of this cup. Now, very, very likely tomorrow I will be adding on to some of those March positions. I probably want to try to take some 92 call strikes as well. I will check the prices in a little bit, but um, I do see a lot of upside. I see a lot of catalysts that can push TLT very, very quickly, very, you know, in that 95 plus area very quickly, very easily. And on top of that, we have the Fed cutting rates. Um, just so many different things that are pushing TLT into a bullish process. We've been in the Treasury bear market for quite a while, and I do believe this is how we're going to see the exit of that. Just going over some of the long trends. I believe I deleted my selling channel. Oh, there it is. We did break the prior selling channel, and I do want to bring up the weekly chart for that. But this selling channel was holding weight for a very, very, very long time. Um, this selling channel actually needs to be adjusted downward a little bit because it has had some dividends. Now, with that said, we've broken a multi-year selling channel, and we're building support at the bottom of that. So I really do think this is going to be the breakout towards that upside. I am very, very convicted in getting not only shares, but, longer contracts. I like the leaps a lot. However, I'm not really focused on those too much yet. I really just want to catch this shorter term move to the upside, and then I'll focus more on the leaps once, we're really, really sure that we've broken the bear cycle. So that's the TLT video. I hope everyone enjoyed, and I will talk to you in my next video. Take care, everybody.